Hey, what's up? It's Stephen A. Williams, president and founder of the creditrepairshop.com. And in today's video, we're going to talk about why your credit score may have dropped. There's a lot of people that write to me here on YouTube and they're like, Steve, I'm following your directions. I'm following what I see on how credit is supposed to be scored to do everything to maximize, my accounts, my payments, everything. But my score, it still went down. Could you please take a look, or could you make a video and kind of answer some of the things that I could be doing wrong? And if your credit score is going down and you don't have any negative accounts, like, I mean, if you got a negative account, period, that's going to affect your score. But you got to understand that credit is an algorithm. The credit scoring system is an algorithm, and it's written and it says, okay, if they're making payments, if they have uh, this many accounts, they even take into account your income that's reported. There's a whole bunch of different things that they take into account. But I'm going to talk about some of the things that I see as common issues when someone scores go down. These are the things that usually had happened if they don't have negative information that was added on there. Uh, Also, I figured out that I didn't even know about this, but my during my videos there was a lot of commercials, and I figured out how to turn that tell YouTube to calm down on that. So it's going to be a lot more space in between. I guess from what they're placing in here. But so if your credit score is going down, you're making your payments, everything is going right, but your scores went down. These are some of the things that you need to take into account. And sometimes people don't take this into account when their scores go down because they're actually doing things the right way. But they're like, if I'm doing it the right way, well then why is my score going down? So here, this is the reason why. So the first thing that you need to look at is your credit card utilization. That's how much of an available credit amount on a credit card that you can use. How much of it are you using? I always say stay within that 30 to 35% margin because the algorithm reads it that way. It's like we want you to have availability to credit, but we don't want you to use all that credit. And we want you to make payments on that credit, because you can actually get kind of a little bit of a penalty for always paying your stuff all the way off. But I recommend doing that, but you got to watch out for certain cards will turn you off if you if you pay it in full every month. But watch out for how much of a credit card that you're using, because that's going to play a huge part in the way that the algorithm is reading it. Because they see what they're doing is when they use these algorithms, they're like trying to base where are you at with your credit? Like, are you just overusing it? If you're overusing it, then you're a higher risk. They're going to bring the score down because their customers, the businesses that run your credit, they want to be able to rate you. And if the algorithm is saying, John is using 80 to 90% of his credit cards every month, and he's only paying down a small portion, you're going to get hit with that. You're going to get dinged with your credit. But if you're using, like, 25, 35%, you're making your payment or even paying them off, you're going to be in good shape. So that'll be the first thing that you need to look at is overall, what is your utilization on your credit cards? Now, another thing that you need to be careful of is that these furniture store cards and all of these different types of cards that are out there now, and department store cards, these cards are credit cards, even though you can only use them in their location. They're like credit cards. So if you go get some furniture, or you go and get some clothes at one of the department stores, and you use up that card, that's going to be the same as using up a credit card utilization, even though you're just looking at paying off, some furniture or paying off some clothes that you had purchased, it's going to be looked at like a credit card. So it's going to hurt you rather than help you. That's why I say you got to be very careful with these types of accounts. In the past, they just used to be an installment loan, but now they're actually using these different banks where they're giving you a card. Yes, you can only use it there, but you can use it and then you can recharge again. Like you can pay it down and you can buy some more furniture or buy more clothes from that department store, so that you're actually using it like a credit card, even though you can't go from different stores. Another thing that you got to watch out for is that statement date. This is one of the things that had actually got me in the past when I was like, hey, I'm paying off my cards. And I was on, like my score would go down and then it would go up, but I had paid off the credit cards, and this is the reason why that can happen. There's a statement date, and then there's a due date for your payments. That statement date is the date that everything for that prior month is going to be lumped in, and they're going to report it. So, say for instance, your statement date is November 2nd, but your due date for making your payment could be November 8th or November 10th. And so if you did any charges, or even though you're going to make that payment and pay off that entire card, what it's going to look like is that you carried over for that next month. And that was something that was happening to me. Is like I was like, why is it going down? But it did shoot back up the next month. It was like I was caught in between these periods. Like it would be like it's going to go 1 month it dropped down like 20 points, and then it would go shooting up, 20 something points or 25 points. And I was like, why is that happening? And I had noticed that the statement dates on, and I don't know if it's the same way for every card that's out there, but with American Express, it was doing a statement date that was before my actual due date on when I would pay off the entire card. So be careful with that because it's like you're carrying over a balance. And then obviously, if you have payments that you're making, you got to make sure that you're making those on time. The other thing that you got to be aware of, and this happens a lot, is when you're adding on new trade lines. When you add on a new trade line, one of the things that the algorithm does is it readjusts your overall payment history. So, as an example, say that you've been paying on your house for like 20 years, and then all of a sudden you go and get a credit card, and you didn't do any stuff. You had other cards and stuff that was maybe 8, 9, 10 years old, uh, and you went and got a new card or a new account, whatever. What's going to happen is that's going to start at zero. That payment history is going to start at zero. So when the algorithm formulates your payment history, your average payment history, it can bring that average payment history way down, especially when you're dealing with one account that's zero. Maybe you have a couple of accounts that's like 5 years, another account that's 8 years, then you have another account that's 20 years, like your home. What they're going to do is they're going to average that. The algorithm averages all of that, and your score could go down simply because your overall average payment history is lower. Now, you've been making your payments, you haven't messed up, you haven't done anything. This is just the way that the algorithm is written. And, there's it, just they're just trying to always figure out what type of way that they can rate someone when they're given the data to potential two companies that are looking at potential people borrowing money from them or getting credit from them. So this is just one of the ways that they figured that one of the ways that we can really understand is how long someone's been paying on an account. But also some of the things that do work against people is, like, because this was something that I did for years. I didn't have a credit card. I had just used debit cards, and I had just had my house payment on there, and it had really worked against me on my credit. Like my credit was just stuck at like 25. Like it just never would move up. And then when I got the American Express card, and then I got another card that I use, it shot my score up to right now I'm sitting at 834, 834, and I think the highest is 850. So 834. So it's just this is the way that they put together the credit scoring system. I'm going to be making some more videos on the credit scoring updates that have been made because there's different scoring uh, methods. The one that was used for a couple of years ago, and then they made an adjustment. And on the one that they made the adjustment on actually had a news report where the bureau said that 20 million Americans were going to be negatively affected, and over 20 million Americans were going to get an increase in their score. So it's like, why would you write a software program? Why would you change the game where you're going to have 20 million Americans scores go down and 20 million plus end up going up? What is the reasoning behind that? There's always some type of reason behind doing that because like why if nothing has changed on this group uh, credit on a negative way, why would you change the algorithm to actually make their scores go down? So that's something that we're going to have to revisit at another date. All right, so I'm going to end the video here. Uh, please subscribe to the channel. Also, watch out for comments from people who are trying to get you to sign up with them. We don't do that stuff on YouTube. Everything goes through our website, thecreditrepairshop.com. Watch out for imposter comments. You'll always see my picture clearly with the Credit Repair Shop with a black circle around with the white letters. That shows that that is legitimately me responding to your comments. If you need help with your credit, please visit us at thecreditrepairshop.com. Watch the video, What Makes Us Different. That's where I'm going to show you the process that I put together over a period of time where I fix my own credit and thousands of other customers' credit using that process, and my two phase settlement process, because you can some uh, credit repair sometimes has to do with debt settlement. If you need your credit reports and scores, please visit the website your3scores.com. If you got debt collectors coming after you, grab my 3-pack of letters, my cease and desist collection activities letter, the debt validation letter, and the statute of limitations letter. And then also if you're interested in getting a trade line and being part of my coaching program, there is a link below also for that where you'll get a trade line. We will work on your credit, or if you don't have any issues on your credit, we'll finance that trade line, which is a big deal. This is a primary trade line, and you'll have the credit coaching where we will go into more details. It'll be, where you have a question on something or you're having an issue with something, we will actually do the research and give you all the options on dealing with that specific problem. All right, thank you for your time. This is Stephen A. Williams, President and Founder of the CreditRepairShop.com.